Welcome, everyone. Today, we're diving deep into the world of finance and accounting, uncovering the most effective analyses that can drive smarter decisions and help you generate lasting wealth. Whether you're investing for your future, managing a business, or simply looking to understand money better, you'll find valuable, actionable insights in this session. Let's get started. Here's what we'll explore together. We'll start by understanding why financial analysis is so important. We'll break down core financial statement analysis. Then we'll look at ratio and cash flow analysis. Next, we'll tackle budgeting, portfolio strategies, and effective valuation. We'll talk about tax optimization, scenario planning, and personal financial analysis. And finally, we'll draw everything together with some practical guidance. Ready to jump in? Let's explore why all this matters in the first place. Finance and accounting analyses are truly the backbone of wealth generation. By applying step-by-step evaluations and using solid numbers, both investors and entrepreneurs can spot new opportunities, avoid major risks, and make decisions that benefit businesses and personal lives alike. Think of it like using a map and a compass for your financial journey. Proper analysis helps you avoid getting lost and ensures you're always moving closer to your financial goals. This is how you build smarter investments, manage resources efficiently, and plan for long-term security. Every analysis is a new opportunity to grow and protect your wealth. Let's take a closer look at the three critical components of analyzing financial statements. Profitability. Here, we're examining margins, return on equity, and return on assets. These numbers reveal how effectively a business turns its resources into actual profit. For investors, companies with high profitability are usually safer bets and have brighter prospects. Liquidity. Liquidity ratios like the current or quick ratio tell us if a company can cover its short-term bills. High liquidity means the business is financially stable. Low liquidity raises red flags. It suggests potential cash flow issues. Leverage. Leverage is all about the balance between debt and equity. The right amount of leverage can amplify returns, but too much can break a company under pressure. Monitoring leverage carefully helps ensure long-term business stability. When you knit these pieces together, you get a clear financial portrait, one that helps you invest confidently and wisely. Ratios are your financial quick-check tools. They let you rapidly compare investments and highlight areas of risk or opportunity. P/E ratio shows if a stock might be over or undervalued. A low P/E may indicate a bargain, unless there's an underlying problem. Risk ratios. Debt to equity and asset turnover ratios help you assess how efficiently a company uses its resources and manages risk. Regularly reviewing these numbers lets you spot trends, both good and bad. Dividend ratios. These are especially useful if you value steady income. Dividend yields and payout ratios point you toward companies with reliable, sustainable dividend streams, critical for long-term investors. Taken together, ratio analysis isn't just technical. It's practical guidance for building long-term wealth. Looking beyond ratios, cash flow analysis shows what's actually happening with money, how it moves, grows, and sometimes disappears. Free cash flow, FCF. This measures money available after all expenses, crucial for new investments or dividends. Positive FCF signals financial strength and opportunity. Operating cash flow tells you if the company's everyday activities are generating real cash, not just paper profits. Cash flow patterns. By tracking cash flows over time, you can detect warning signs, like sudden drops, or confirm things are on track with steady increases. Understanding cash flow is essential because it's the reality behind the numbers. Healthy cash flow means a business or your investments can survive and thrive. Let's talk about proactive planning and why it matters. Budgeting and forecasting help build financial discipline. One powerful method is zero-based budgeting, which means every dollar gets a job, there's no wasted cash. Rolling forecasts, on the other hand, enable you to adjust your plans as new information comes in or as conditions change. Combining these approaches creates a financial roadmap that adapts and evolves, keeping your investments, business, or personal finances aligned with both goals and reality. Now, how do we build and maintain a powerful investment portfolio? Asset mix. Modern portfolio theory teaches us to spread investments across different asset types. Diversification is key. It protects against overexposure to any single risk. Diversification. Stress testing your mix of assets using scenario analysis reduces vulnerability to market swings. Performance. Regularly monitor both your returns and volatility. Continuous feedback helps you stay on course toward your target outcomes. Review. Ongoing portfolio reviews ensure you can spot changes in risk or opportunity early, letting you adjust before issues become costly. Active management and constant vigilance help your wealth grow and stay protected over time. Next, let's demystify how to determine what investments are really worth. Discounted cash flow, DCF. This method calculates what future income is worth today. It's crucial for valuing stocks and real estate. Comparables analysis. This approach benchmarks assets against others like them, helping buyers avoid overpaying and sellers get fair value. Overall valuation. Ultimately, good valuation methods directly impact the quality and profitability of your investment decisions, whether you're buying, selling, or holding for the long haul. These techniques set you up to make informed, strategic wealth-building choices. Taxes can make the difference between great returns and just average ones. Effective tax planning keeps more of your investment gains in your pocket. Taxes. Proper planning uses strategies like tax loss harvesting, selling losing assets to offset gains and reduce your tax bill. Structure. Choosing the right entity setup, such as an LLC or S-Corp, can further minimize taxes and boost control over your investments. Strategy. You'll want to adapt your tax strategy constantly as the laws and your portfolio evolve. Tracking after-tax performance helps you fine-tune your plans and maximize how much wealth you keep. Life and markets are unpredictable. Scenario and sensitivity analysis give you the tools to prepare for whatever comes your way. Monte Carlo simulations. By running thousands of possible futures, you can stress test your investment, retirement, or business plan. Sensitivity analysis. This technique reveals how changing one key factor, like interest rates, can ripple through your financial plans. What-if planning. Modeling what-if scenarios exposes vulnerabilities and identifies opportunities for improvement, building your financial resilience. These analyses turn uncertainty into a manageable part of your financial strategy. At a personal level, financial analysis is your ongoing checkup, a way to guide decisions and safeguard your future. Net worth. Tracking your assets and liabilities over time helps you see progress and spot trouble early. Retirement planning. Using calculators to plot savings, spending, and withdrawals helps you build a secure, comfortable life after work. Personal planning. Regularly reviewing your lifestyle expenses, saving rate, and investments allows you to adapt as your situation or goals change. Constant review and adjustment keep you on the path to lasting financial success. For entrepreneurs, keen analysis of your business model is vital for maximizing both profits and long-term sustainability. Unit economics. Focus on profitability per transaction to ensure you grow in a healthy way. Customer lifetime value, CLTV, versus customer acquisition cost, CAC. This comparison shows if your marketing and sales spend is building value. High CLTV, low CAC is the ideal. Growth and efficiency. Building workflows and systems that scale efficiently lets you replicate success as conditions change. Summary. Frequent review ensures you can quickly adapt and protect your business's future returns. Bringing it all together. Smart financial analysis is about seizing opportunity, minimizing risk, and making informed decisions at every step. Used together, these analyses help you spot the best opportunities, steer clear of costly mistakes, and optimize the after-tax returns that build real wealth. Regular tracking and dynamic forecasting ensure your resources are always allocated for maximum benefit, whether you're growing a personal portfolio or scaling a business. Ultimately, real wealth results from adapting to change, testing your assumptions, and continually refining your approach for each stage of your financial journey. Let's wrap up with a real-world example. If you're considering a rental property investment, you might start with cash flow analysis to check that income exceeds expenses. Next, you'd use discounted cash flow or comparables to avoid overpaying. Tax optimization can help maximize your after-tax returns. Finally, scenario and sensitivity analysis allow you to stress test your plan under different market conditions, making you better prepared for success. By applying these tools in combination, you'll invest with more confidence, manage your assets more effectively, and have the agility to adjust as markets or personal circumstances change. Thanks so much for watching. If you enjoyed this video, don't forget to hit that like button, subscribe to the channel, and tap the notification bell so you never miss a new upload. Your support really helps the channel grow. See you in the next one.